Well, let's say hello and good morning to Sandip Sabharwal. And Sandip, as we walk into trade this morning, there is a lot of news flow. Let's start with banks, Kotak and SBI. You've been bullish on Kotak for a while, but numbers do not cut a lot of ice. I mean, they are not impressive at all. What went right, what went wrong for Kotak for the quarter gone by?
So Kotak has been more of a comeback to normalized valuation trade at a time when they were facing issues related to RBI restrictions on some businesses. So I think those have got removed now, and to that extent, they are in a better state. So Kotak, as all of us know, used to trade at price to book of 6 times 5 years back, which was quite obnoxious. It's come down to 2 times, which is reasonable, like in line. So today, on valuations, on a price to book basis, it's cheaper than HDFC, ICICI, etc. That said, we've seen the first wave of the move towards normalized valuation from suppressed valuation or play out. The results which have come out, because of that, there is no case for any significant immediate up move because results were subdued in on most parameters except for asset quality, which obviously has improved, and that's the key feature of most bank results, that they have not tried to show higher profits, but most of the banks have focused on keeping the net NPAs low by even providing higher, and which is good for the overall health of the banking sector. I think Kotak uh, should remain range bound for some time. Directionally, for banks, large banks, things should be okay because while reducing rates in the short term by the repo rate reduction hits margins, but it improves the prospects of credit growth over the longer term. So I think uh, 6 months down the line, we should see credit growth start to also pick up for banks, and that will be positive.
So let's look at the banking space, Sandeep. And in banks, we can only do the following: identify the outperformer, identify the underperformer, and perhaps also talk about the market performer. So within the banking space, give us names. What could outperform from here? What could underperform? And what could be a market performing basket?
If you look at managing asset liabilities in a manner to where they are able to hold the NIMs, I think ICICI Bank's done the best. And that's also reflected in the stock price movement of the bank. So I think ICICI Bank will continue to do well. Uh, Axis Bank, I think, is cheap relative to all other large private sector banks, and under the current management, it has been very conservative in managing its balance sheet. So we should always like conservative managements in banks, not aggressive ones. We've all seen what's the fiasco in IndusInd Bank, etc. So I think they'll do well. And SBI, I believe, is very cheap on valuations relative to its size, the fact that it will still grow at market rate, and the net NPAs. You look at the asset quality of the bank, I think it's the strongest in so many years. So I think it's underappreciated. I believe that there's no reason why SBI should trade at one time book and many other large private sector banks should trade at 2.5, 3 times, even with the PSU backdrop. I would think that re-rating of SBI should happen over the next couple of years.
Okay, that's the take coming in on banks. Sandeep, hi, morning. Did you look at Avenue Supermarts numbers? Weak numbers. I mean, the competitive intensity is something that we've been working with and talking about as a threat for many quarters now. But do you think it's in the price? I mean, the stock, I was just looking at it from 3,300 thereabouts, it's already climbed up to 4,000. Still a long way to go before it hits its 52-week high of 5,400 thereabouts. How much of the negative news you think is already in the price for demand?
I would rather think that a lot of more positives have been built in because people assume that profitability will come back, which it has not. So in a way, as far as long-term strategy goes, what they are doing is right. They are finally recognizing competition, the fact that they need to address competition head-on and also grow aggressively. So they can't be stuck at the same number of stores and just maintain profitability. So they have to take a hit on profitability in the short run in order to capture or retain market share or grow in new segments long term. So I think their strategy is good long term, but in the near term, the earning picture does not reflect uh, any upside potential. I would think that the stock is very, very highly valued at these prices.
We've spoken about banks. Let's look at a larger list of stocks where you think large cap, mid cap, and we'll use the criteria of market underperform and outperform. Market performer, I mean, no point in discussing it. What to your mind are some 2-3 stocks which can outperform the market, and which are some stocks which you think now run the risk of underperforming because of news or valuations? Sandeep.
Among the large cap, if you see, I think Reliance has started its outperformance cycle now. So I think that will sustain for the next couple of years. So when the initial move happens, a lot of people think after a long time, people think that it's already done. But I think uh, what the management is speaking of in terms of getting returns from new energy ventures, etc., I think that will help valuations or improve. I think from a de-rating cycle over the next 3 years to re-rating going forward. Other than that, I think many auto infra stocks are underestimated in terms of growth potential this year because the managements will be most bullish when growth is high, they'll be most bearish when the growth is low. But we have to look at the macroeconomic parameters in terms of tax breaks, lower interest rates, etc. And I believe that will boost growth of in many segments in the economy domestically, as well as lower rates will help the profitability of many infrastructure, capital good, etc. companies. So I think these should be segments people should focus on.
Reliance and construction stocks, when I say construction stocks, you would say NCC, Ahluwalia, the ones you've liked historically.
And then these companies will do well, and there'll be others also. I think there are a lot of companies which directly benefit when interest rates go down because interest rates play a strong part in the overall availability of liquidity for execution, as well as it cuts down the interest rates, interest costs on the balance sheets.
Let's talk about Marico as well. The 7% year-on-year volume growth was, while largely in line, it was a little bit of a miss, but one has to say that within the FMCG peers, Marico is definitely better positioned. While FMCG may not really be the flavor in the market right now, it's all about banks, underperformers like Reliance, etc. But the fact that their volume growth came in at 7%, it's interesting to see that it's completely been led by their new and diversified, portfolio. Foods, digital-first brands, which are now contributing to a good 22% of their domestic revenues. Sandeep, what are you making of the entire FMCG space? Because I remember you were talking about as to how at some point this year, at the end of the quarter, these stocks may bottom out.
I think as the results come out of the FMG company, which will be subdued in general, so obviously Marico, like you rightly said, has been an outlier, not only for this quarter, for the last few quarters also, and that's reflected in the way the stock has moved relative to the entire sector. So I think consumer stocks growth should bottom out in this quarter, and then we should see a revival cycle. So I think based on the stocks, whoever likes what kind of stocks in terms of consumption, they should look at buying them at that stage because I would think as 2-3 years of subdued growth bottoms out, we could see a couple of years of relatively better growth going forward.
What the OMCs could actually do. And there's an interesting note on a BPCL coming in this morning as to how the Russian crude imports are likely to pick up in the first quarter. Capex is going to materially increase for the next 3 years. Sandeep, purely because of the decline that crude has had, do you think OMCs become at least a tactical play?
I think tactically they should obviously do well because given the way crude has declined, especially over the last 1 month, the margins would have zoomed up for most of these companies. And the government has been reluctant to allow any price cuts to flow through to customers. And in that scenario, I think they are sort of in a very good position where in any case, the results also were much higher than expectation across the board, HPCL, BPCL, IOC. I think one, results have been good, and second, profitability improvement could be much even better in this quarter and next quarter. So I think they are well placed.
Right. Very good morning to you, Sandeep. And given the way how the markets are panning out at this point in time, what's your take on some of these two-wheeler majors? What's your take on them, given the fact that you already had the auto sales numbers coming in? TVS Motor, case in point being the earnings were really healthy of that one, and you saw the stock also react to that. What's your take on the entire two-wheeler pack right now?
TVS obviously has been outperforming in terms of the numbers, and that's also reflected in the stock price, because the stock price as well as valuations of TVS have moved totally, let's say, different from that of Bajaj or Hero, which have gone the other way. Now, as far as overall two-wheeler growth goes, it's somewhat surprising that the growth has not picked up despite a good marriage season, improving liquidity scenario, etc. But I think that could be because it will impact the market with a lag. So I would think that second half of 2025 should be much better for the overall auto industry and two-wheelers specifically also. So to that extent, the segment overall should do well.
Sandeep, what are you making of M&M? Of course, it's had its heyday as one of the top performers within the auto pack. The Isuzu deal, of course, is strategically positive. The execution, of course, remains key. But do you think for now the stock is priced to perfection?
I won't say it's priced to perfection because of the fact that they've been gaining market share in tractors, which is a highly profitable segment for them. And tractor sales are expected to be good for the next couple of years. And on UVs, they continue to do well. So I think now it will depend on the results and numbers, etc. A cycle of re-rating has happened. The stock has reached a valuation zone, which is not very expensive, but not very cheap also. So I think earnings growth will determine how the stock will do going forward. There is no reason to be bearish per se. I would think that the company is doing.
All right, so that's the take coming in on M&M.
Sandeep, what is your own take? I mean, I was just reading this morning that Oberoi Realty has actually registered gross booking value of 970 crores at one of their new towers in the Oberoi Garden City, Goregaon. It's quite exorbitant the way some of these luxury real estate, the premium condos are actually selling. But how do you think the space is looking like within the listed pool?
Raja, I think that's been my view over the last few months also, that I think the best of the growth for real estate has been done in the near term. We have to go through a phase of consolidation, some possible price correction, which could get moderated by the interest cuts, obviously, which benefit real estate sector. But I think a lot of positives are already in the price. So, and you would also have seen that incremental news about increased gross bookings or new bookings, etc., have stopped having a significant impact on these stock prices lately. So I think many investors realize that valuations are no longer cheap, and post consolidation or possible correction, we could have a relook in a few months.
Okay, Sandeep, good to have you on the show. Thanks as always for your time. Good speaking with you.
If you like this video, then like, share and subscribe to ET Now.